SoftBank did not sell NVIDIA by mistake. They were forced to eat their best asset to survive. Here is the real reason. The real reason SoftBank sold its NVIDIA stake was not a sudden loss of faith in NVIDIA's future, nor was it a simple misjudgment of market timing. It was a forced liquidation, a desperate measure driven by the structural demands and mounting failures within the Vision Fund itself. The Vision Fund, like many private equity and venture capital funds, operates under specific rules. It requires mark-to-market accounting, meaning assets must be valued regularly to reflect their current market price. When those valuations plummet, as they did with WeWork and others, it creates a cascade of financial distress. SoftBank needed immediate substantial liquidity. Most of its portfolio companies were illiquid private entities or struggling public ones. Selling a large stake in WeWork or Uber at that moment would have been disastrous, further tanking their share prices and confirming the market's worst fears. NVIDIA, however, was different. It was a highly liquid, publicly traded company with a strong market position and clear growth trajectory. It was the one asset SoftBank held that could be sold quickly, in large volume, and at a fair market price without collapsing its own value. It was the only viable option to generate the billions needed to staunch the bleeding elsewhere. The sale of NVIDIA was not a choice made out of strategic foresight. It was an act of financial triage. SoftBank sacrificed its best-performing, most liquid asset to bail out its worst-performing, most illiquid investments. The fund structure, with its focus on short-term valuations and the need for periodic liquidity, compelled this seemingly irrational decision. The cost of this forced sale is staggering. That 4.9% stake in NVIDIA, sold for roughly $4 a share pre-split, would today be worth over $40 billion. It represents one of the largest missed opportunities in modern financial history, a direct consequence of systemic pressures rather than poor. If you found this deep dive into mispriced capital revealing, consider subscribing to Mispriced Capital and hitting the notification bell so you do not miss our next analysis.